Good afternoon, everyone. Welcome back. I know you are on these typically every Thursday at 2 p.m. Eastern. This is the second one of the year of 2026. So just want to thank everyone. I hope you're off to a great start. And what we're talking about today, and I know we have a lot of interest in this market and this part of the industry, as a matter of fact, is large cases, right? We always get a phone call, an email, right? And they're like, Bill, I got a guy, I got a girl, and I need some support or recommendations. What product or carrier or platform should I use? And we get these a lot. And the bottom line is typically these are monster cases, okay? Anywhere from 100,000 of target annualized premium to over a million, okay, per case. So this is a life changer for a lot of agents and advisors out there. So of course everyone's interested, and as you know, we have over 24,000 agents from Key West to literally Hawaii. Okay, and some of you are more focused on term life insurance sales, maybe some final expense. And then on the other side of the spectrum, we have a lot of agents that are MDRT producers, right, that do focus on the large case market. But the bottom line is no matter what side of the market you're focused on today, is that you know enough to be dangerous, right? To speak to these prospects and sound intelligent and like I said, just making sure that you're comfortable with some of these terms and platforms. And then once you have the guy or girl, Michael and his team will help you. They will support you. Okay. And no, you're not just turning over a referral and your client. Okay. You still are on the application. You still earn the bulk of the commission. Okay. So this isn't like a referral ticket that you submit. You still remain control of the case and in control of your client, which is most important. So that's what we're talking about today. These are life changing cases and opportunities to help your clients most important with estate planning, asset planning. And then, just before I shift gears for a second, think about this too. And I looked at some of these statistics earlier. And when you look at last year, 2025, right, for some of these wealthy families in the US, over 50%, okay, and this is a survey, you can look it up online through AI or Google, over 50% do not have an estate plan, okay, 2025 for wealthy families. Over 50% don't have an estate plan, and then 83% worry about issues when there's a transfer of assets. So, again, is the opportunity large? Absolutely. Can you put together some creative marketing after we finish this webinar? Absolutely. And we even have some great templates and email ideas that we're going to share. We also will have all of this on our website under, if you want to, in fact, look at, we'll include it in the link, but advanced case design and strategies. Everything is there. And then Josh Hoffman in the office can also help you. All right. And then at the right time, we will get SCA involved as our third party partner with this platform. So very, very good stuff to come. Make sure you're paying attention. Any notes, questions, comments, please use that Q&A pane, which is part of the GoToWebinar software, and we will get to every single person as soon as we finish up at 3 p.m. Eastern. And then, like I said, I'll send out a thank you email to every attendee, which will give you enough information to be dangerous. And then if you have a guy or girl, we have an email me form, fill it out, send it in, and then we will get you to the right place. Okay, so let's fast forward to our first slide here. I'm going to talk about just a couple things for a few minutes, and then I'm turning it over to our feature presenter, Michael from SCA. So this is going to be a good 45 to 50 minutes here today. Okay, so you, our agents, are our number one, our customer, right? We are 100% wholesalers, distributors in the insurance and annuity space. As you know, we don't sell in a call center out of the back room. I think it should be illegal. But the bottom line is you are our number one. And when we see these reviews on our Google link, on our Facebook page, it means everything. So, Andis, I saw you're on here right now. I see your name on the list. But I saw this come in a couple days ago, and I was floored. And I'm not going to talk about every single word, But what you shared here for us and for other agents is outstanding. Okay. And we spread this around the office. And again, this is what moves the needle internally for our staff, our family, right? We look at ourselves as one unit. And please keep sharing stuff like this. And hey, we're not perfect. I always say 99% of the time we're going to do a fantastic job. 1% of the time we might make a mistake. We're human, but reach out to me or Carrie, okay? And we're going to jump in and try to make it right for you. That's our promise. Okay, anyway, right hand side, Gregory, who runs Insure Me Now Direct. This was an agent, Betty, says Gregory has gone above and beyond with his service in setting up my Insure Me Now Direct website and link. Again, thank you for sharing. Please, if you're on listening today or 2 weeks later down the road, please share a review. We want to hear from all of you. Let's keep moving forward. I want to talk about our big powwow for the year. So it's coming up on April 17th, April 17th, 2026. Save the date. We're a few months away. We have a fantastic keynote speaker who's a member of the Forbes Council that's joining us this year, on top of one of the members of the AmeriLife executive team will be there. We have our new lead vendor, our new benefits team will be there. So it's going to be amazing. We're going to have 10 core carriers on the life, annuity, and health side. Make sure it's complimentary. Make sure you are registered because we're capped at 300. And then, of course, you can qualify for a 2-bedroom beachfront suite, 1 to 2 nights, and round trip airfare. All premium counts. Okay, so just take a little screenshot, bottom right corner, or if you have your iPhone, take a picture, whatever. I want to make sure you get in that premium and qualify. We will fly you in from anywhere in the country, okay, including Hawaii, which we have a few agents that are coming in from there. Okay, let's keep moving forward. This is our annuity and life alert. We send this out every other week. So with all of the new updates, technology, carriers, products, benefits, right, all the above, it's very hard to keep track. There's a lot of moving parts, especially in 26 with Levinson. So all you have to do, keep your eyes peeled for this email. Comes out every other week, sitting in your inbox. If you don't get it, could be in your junk folder, or maybe we have your incorrect email address. If we do, just call us and we will make sure that you are in the database correctly. Okay, let's keep moving forward. I have my official intro slide up next. So what we're going to do now is Michael, like I said, our RVP with SCA is going to take the wheel. He is a new partner of ours with our latest AmeriLife partnership, which happened a few months ago. So we are delighted to share the stage, so to speak, with Michael. Are you there, Mike?
I am here. Thank you so much, Phil. It was an excellent introduction. I appreciate it. I'm very excited to be here with all of you. Hopefully, we're going to try and get through a lot here. Obviously, love questions, so feel free to put them in the chat. I don't know if we'll have time to get to them at the end, but if not, we'll make sure to answer those questions after. I am just going to dive right in, and I think the title slide here is the premier partner for Elite Advisors. That is how we have defined ourselves as Succession Capital over the past almost 30 years. We've taken new advisors, brand new to the business, and helped them on their journey to becoming elite advisors. And 100% of our business is in partnership with advisors. And we pride ourselves on that. We do not go direct to client. We like to work with the best in the industry. And that's why we're really excited about this partnership with Levinson Associates. So I just really quick, in terms of our agenda, these are kind of the 5 key things. I got a lot of case examples. I don't know how much time we're going to have, might not get to all of them, but I want to start on first, what do we do as a firm? Then we'll talk about how big this opportunity is. I think a lot of people do not comprehend the opportunity in this space. And then what exactly is premium financing? Of course, that's probably an important piece to start on. And then we have some case examples, which the idea behind the examples is certainly not to show off. It's to spark ideas in all of you of a client you may have seen, a client a potential client that you've run into, or ideas of clients that you already have sold to that could be another great opportunity in waiting there. And then lastly, next steps, I'm going to talk through kind of what you guys can do to take the first step to start working with us and working on these larger cases with high net worth clients. So starting off, if I could summarize what we do and our reputation in the industry, this is all that matters to us. If our partner advisors have success, then we are successful. And I tell advisors, look, if we can partner with you on a case and your closing rate goes from 50% to 60, it's worth that, whatever comp you're sharing with us, more than that, right? So this was a case example. I met with this advisor, and this was probably 2 years ago now, but he came to me and said, look, I think I'm comfortable showing this client $4 million. Can we show what that would look like with your strategy? And the net to him, if he did it by himself, would have been about $100,000 of commission. We looked at the financials. I met with our principals. We came up with a strategy, and I told the advisor, this client needs $20 million of death benefit. It was for estate tax planning purposes. And ultimately, we gave this advisor the confidence to present that and show options on how to pay for it, of course. And the net to him was tripled. That's after we took a part of that case as well. So this advisor he had never sold a case as large as $20 million. For him, that was mind-blowing. And we gave him the confidence and the tools he needed to get that case across the finish line. So this is what we are all about. How we do that, this is our process from soup to nuts. First, we work with advisors in identifying what is the need for life insurance for this client, whether it's estate planning, buy, sell, key man, estate equalization, you name it, estate taxes, like all of these, there has to be a problem that we're trying to solve. And we really help formulate that in a really simple way that clients can understand. Only then do we move to the next step, which is incorporating in-force coverage if they have it. And then we establish always, in all of our cases, a non-financed option that we present to the client. And that is not a non-financed option that helps make the financed option looks better. That is the best non-financed option we can come up with. And sometimes for buy-sell, that could be term. But typically, beside that, we'll design a premium financing alternative if it's suitable for the client. Not every client we look at, premium financing is suitable, of course. So we got to make sure it's suitable. And then we'll compare those side by side in our presentation to the client. And I'll emphasize this later, but we are trying to get the best possible solution for the client, financing or not. And about 20% of our clients decide to pay cash. That's just the typical way that it works. And for us, it doesn't matter. We don't get paid extra if they finance. We don't make money on the loan. There's no additional comp there. And then the sixth step really for us is support. So typically we are on a Zoom or in person meeting with the client and sharing this concept and presenting to them. And as needed, of course, on the loan underwriting, if they're doing financing, we'll be there as well. And lastly, a piece that often gets missed for people who are doing this for the first time is these strategies require service for a long time. And we have an industry leading service team that is there at their white glove service on an annual basis, meeting with you as the advisor and the client as needed. Okay, jumping into it here. So a lot of people that I run into since I started doing this about 6 years ago, they would assume, look, if interest rates are low, this is probably a great idea. If interest rates are rising, you probably don't get any business. I am here to tell you that in the past 2 years, we have almost doubled our business as a company, despite the fact that interest rates we're at in the 7% range, right? Clients that need this solution, meaning life insurance, if you can really establish that need and show them their options, life insurance is the most efficient way in most cases to solve those problems. Whether or not interest rates are at 1.8% like they were 4 years ago for some of our cases, or 6.5%, it is still the most efficient way. And we can mitigate a lot of that risk for a lot of the strategies that we use as well. So this is not true. We have a lot of clients that do this and have continued to do this, and even more so over the past couple of years. This is just a little bit of our history. We're coming up on 30 years. This will be our 30th year in the industry. We've funded 69 billion of death benefit as a firm, and we currently have a loan portfolio at around $7 billion. So the reason I share this, again, not to brag, is to say that we have a track record. We were the only firm in the industry in 2008 that was able to refinance 100% of our loans that were on the books. And because of that, we have the respect of the carriers and the industry as a whole. And we have seen high interest rates, low interest rates, massive recessions, booms, as we're seeing today in the markets, right? So it's important to partner with a team that has the experience and has been through it all. Okay, jumping into kind of the second portion of this, I want to talk about the opportunity, the size of the magnitude of the opportunity here. And it may be in a fun way to kind of approach this. I don't know, how many people are on the call that are a fan of Celtics. I'm not a Celtics fan, but I read this story in the Wall Street Journal, and it really speaks to exactly what we're trying to do with our ultra high net worth clients. The Grousbeck family, who owned the Celtics, they had just won the championship of the NBA. And immediately, I think it was a week or two later, they came out with this announcement. The controlling family, after considerable thought, has decided to sell the team for estate and family planning considerations. I might get the numbers wrong here, but they bought the team, I believe, for around $300 million. And I think they sold it for somewhere between 5 and 6 billion. As you can imagine, that is a massive capital gains tax. But the reason that they sold it is because despite the fact that this family were billionaires, if mom and dad passed, and I believe they're in their late 80s, they would have roughly $2.5 to $3 billion estate tax due just on the asset of the Celtics. And their kids, who one of which is holding the trophy in this picture, would have 9 months to come up with that in cash. The IRS is not going to accept, part of the team as their payment, right? They need to come up with $2 to $3 billion in cash within 9 months of mom and dad's death. Now, obviously, this is on a scale that is enormous, and we work with billionaire clients often, but this is true for any client who's married worth over $30 million or who will be worth over $30 million at their death. Every dollar over $30 million for a married couple is taxed at the estate tax level of 40%. And it's the same problem. How many clients that you can think of who have that level of net worth, they're invested in real estate, private equity, maybe it's their own business. These things are not liquid, and coming up with potentially 40% of their net worth in cash in 9 months is not an easy thing to do. So, we have some clients that say, that's my kid's problem. It's not. This is a family problem that can cause significant repercussions for the business, the real estate, and family dynamics as well. So looking at the numbers here, this is for ultra high net worth clients, right? Oh, sorry, skipped over that one. But in the United States, there's over 140,000 American households that are worth over $50 million. In 2021, 369 households filed returns, gift tax returns or estate, at their death, with an average estate size of 148 million, and they were worth on average, at minimum 50 million net worth or above. Their average tax due was $30 million. Only about 1,000 people buy $30 million of life insurance annually. That means that essentially there are 139,000 ultra high net worth households not buying enough life insurance. And they're all over the country. Right? We work in all 50 states, and they are all over the country. As Bill said, 50% of them do not even have a basic estate plan done. So if 30 million just on average generates 750,000 of revenue, that's over 100 billion in revenue that is not being sold by advisors just in the ultra high net worth market. And I'm not even going into the 20 million and above range because that's massive as well, when there's a huge opportunity there too. So every one of these 140,000 households is an opportunity, even if they already own insurance. We see them all the time. They already have insurance, but they do not have enough, or it's not structured properly. Many of them own it in their state, things like that. So the way I like to approach this subject with clients is, you think about it like this. An ultra high net worth client, they basically have two different kinds of assets. One we call a legacy asset, and this is what they're going to leave to the future generations. Then their lifestyle assets. This is what they're using while they're living, to pay their bills, to whatever it might be. But the interesting thing is, in most cases, 99% of their assets are really legacy assets. They're not going to spend it all before they die. And we see that here. Most advisors that we work with, though, they are constantly talking about how to improve the return on the lifestyle assets, what they can do to help get an extra % return on their money. And so these conversations ultimately are the reverse of what the assets are. 90% of the conversations are about lifestyle assets, and maybe 10% is about legacy assets. So we really want to flip the script on that, if you will, and talk about what is the biggest concern for them. And the other benefit to that, quite frankly, is that lifestyle asset planning, it's a hard market. It's limited barrier to entry. Anyone can try and do it. I'm not going to say they're doing it well, but it's a commoditized product, minimal innovation, most amount of competition. It's hard to add value. And typically, the relationship dies with generation one, right? Whereas legacy asset planning, there's a huge barrier to entry. A lot of it is knowledge, resources, connections, right? Minimal competition. There's not a lot of people doing this, and it requires highly specialized knowledge. It's innovative and creative ideas, and some of that we're going to dive into today as well. But it adds a tremendous amount of value to clients compared to lifestyle assets. And ultimately, it creates generational clients. Clients that will continue, their kids, their grandkids, will continue working with you as the advisor because you set them up for success. So ultimately, what the point of this presentation is, we want to help bridge that gap between lifestyle asset planning and legacy asset planning for the advisors who aren't in that space yet. And we want to try and help enhance that for the advisors that already are. So what I ask you guys to do is ask the next question to your clients. Are they aware that the estate tax will be the largest single expenditure they and their family will ever pay? Do you know that they can save 90 to 95 cents on the dollar just by planning ahead? Like, these two questions are very simple, and really can start the conversation. So diving into what we do, I was going to ask here, like, how many of you have done premium financing? And what I typically hear is there's a number of people that have, and the people that say they haven't done premium financing, I kind of push a little harder, because a lot of them have, and they don't really know it, right? As you know, the lifetime exemption is 30 million. Many ultra high net worth clients have already used that exemption. So why I say they have, but they don't know it, is because anytime you're trying to pay a life insurance premium inside of an irrevocable trust, they either have to loan the money, which is a form of financing. And from the trust perspective, it doesn't matter if that loan is coming from a third-party lender or the grantor, or they have to gift it. And if they've used up all their gifting, that's not an option. So financing, we've met with a lot of attorneys on this, and they set up structures where, no, we don't do premium financing. And sure enough, they have a split dollar agreement. The grantor is loaning to the trust, and they bought a level death benefit. And so they've ended up paying, let's call it $6 million of premiums on a level $30 million death benefit. And we explained to them, do you realize that that's only 24 million of death benefit now, right? Because the first 6 million has to go to pay back the grantors. So from a trust perspective, a lender is a lender. And if these policies, even without a third-party lender, are not structured properly, it is diminishing returns and is going to eventually create a massive problem for the trust, the trustee, and ultimately the grantors as well. So whenever this is the winning formula of a finance case, and whether that's grantor financing or third-party financing, has to have an increasing death benefit to offset the premiums that are paid into the policy. And front-loading premiums makes these so much more effective and more efficient in order to also have an opportunity to exit the loan as needed later on. And ultimately, that's what leads to the efficiency and effectiveness of financing. All right. So now, next, I wanted to I always like to get this out of the way right away. The elephant in the room, the first question that anyone who's skeptical of financing has is obviously interest rates. How does this work with high interest rates? We touched on this a little bit at the beginning, but interest rates are a part of financing. So I want to talk through how we deal with that discussion with clients and with advisors who haven't done financing or are skeptical of financing. First, we have to start with the problem. If you present financing as a gimmick or a really exciting thing without giving context to the problem, it doesn't work. And this is where a lot of advisors and groups that frankly do this for the wrong clients get in trouble. We always start with the problem. As I said, let's just assume it's a $30 million estate tax problem. There's really only 5 ways to solve that, Mr. and Mrs. Client. And then once we agree on the problem, then we start to look at the solution and the product. If you start with the product, in other words, you go and say, hey, you should check out premium financing, that is the wrong approach, because we need to first understand what the problem is. So we'll tell a client, look, do you realize that your family, shortly after you and your wife die, are going to receive a letter that looks exactly like this from the IRS? They are going to have to come up with $30 million within 9 months to be sent to the IRS. Now, you can ask the client, if this was an income tax letter and they found out they had to pay $30 million, they would immediately drop everything they're doing, get all their most important trusted advisors in a room, and they wouldn't let anybody leave that room until this was solved. But because it's down the line, I don't know, I'm not sick, I'm not dying, they always put it off. And that's what we're trying to emphasize, the importance of doing this by starting with the problem, the severity of the problem. And then how do we talk them through that? So, okay, you understand that there's a $30 million estate tax. Now, what's your current plan? How are your kids or beneficiaries going to pay that? Well, it has to be one of these 5, because these are the only 5. Aside from gifting everything to charity, that could be another one as well. Give nothing to your kids and give everything to charity. But first option, they will have a fire sale on their hands to sell business or real estate. Second, try and get a loan against those assets, but I can tell you right now that is almost impossible. Third, they'll use cash. Do you know any client that's worth $100 million that has 30% of it in cash? I have yet to meet them. If they do, I'm sure they're using that cash or preparing to deploy that cash in a more efficient way anyway, so they don't want to just keep it in cash. The fourth option is a 6166 election. We have clients that have gone through that with their parents and are doing everything in their power to avoid that for themselves. Essentially, your kids become a partner with the IRS for 15 years, paying principal and interest. And in many cases, that cash flow takes up the entire cash flow of everything they inherit because it's so high. So that is the worst option possible. And then last one is life insurance and good planning. And I always tell them the first 4 strategies have 2 things in common. One is good, one is bad. The first that's good is that you don't have to do anything. It's your kid's problem. They're going to have to choose one of these 4 problems. The one that's bad is they are by far the most expensive. And then we show them kind of an estimate, given their circumstances, all of these are tailored to the specific client, what that cost structure would look like, right? And so we share this screen and this as an example and say, look, all these, you're going to cost 120% of the actual cost. If you have cash, it'll cost dollar for dollar, 100 cents on the dollar. If you do the 6166, it'll cost 160%. If you do life insurance and planning, we can get that down to 10 to 20%. Now, going back to the interest rate discussion, what does that mean? If we're wrong on interest rates, by the way, 3 to 6 is a spread of double, significantly higher interest rates, right? But let's just say we're off by an order of magnitude. So let's just say interest rates are 3 times that. Well, what does that mean? So, okay, I'm sorry, it's going to be 9 million instead of 30. I mean, we're still in the game in terms of competitive, right? That's what I mean by interest rates don't really matter for a client that has a problem at this scale. And that's assuming also that we don't have other mitigating strategies to mitigate that risk of high interest rates, which we do and we walk through with the client as well. Last thing on this is ultimately our goal is to get clients into this discussion, which is very hard. Everyone's caught up in the crises and the interruptions, right? Urgent and important. If we want to get this conversation to get them to start thinking about the not necessarily urgent problem, but that is extremely important and that will have an impact on a much larger impact than how much they're going to earn this year on their returns on their portfolio, right? And if I can describe what we do in a nutshell, it's really trying to make these problems and these solutions as simple as possible. The more we can reduce complexity, the easier that decision is for the client. Okay, the second piece on this subject is really that we are not selling financing. Ultimately, we're offering a choice. And this is exactly what it looks like when we present to a client. We are showing them on the left, paying cash, this is your option one. There's nothing wrong with this option. A lot of clients do this. But here's option two, which may or may not be a better option for you. And we walk them through this, right? And our founder, Julian Movazian, he has called this the power of choice. And I think it's brilliant. It's like ultimately, and Chris Rock, I love this quote, wealth is not about having a lot of money, it's about having a lot of options. If you go into a meeting with a client and you're giving them one option, they're immediately going to start thinking, I need to get a second opinion. But if you come in with 2 or 3 really good options, they have a much lower likelihood of going somewhere else to try and find an alternative. And so ultimately, our job is to increase the likelihood of closing that case for you and getting the solution for the client. Our role as your partner is to give those cases the highest probability of success and give clients the power of choice to do that, right? Third, we let the client choose, right? This is another one. You'll see some of these in the cases, but essentially we show them, now that we've understood the problem and the gravity of the problem, here is from our perspective, your 3 best options, 1, 2, and 3. Which one do you want to dive into? Which one do you want to understand more? And ultimately, it's up to them. It's that simple. Finally, I will emphasize with regards to the interest rate topic that the success or failure of any permanent IUL, especially financed or not, depends on servicing. I worked on a case a year and a half ago for a billionaire client. They had $75 million of survivorship in IUL on their clients. It had not been serviced in 20 years, and it was going to lapse at the wife's 79 years old. So, and there was no financing involved in that case, right? So it's not just financing cases that service is important. It's all cases. And unfortunately, a lot of advisors are not servicing their clients well, which is a great opportunity for all of you because you can dig into their in-force portfolio and find opportunities. So as I said, we're a leader in terms of servicing our clients, managing funding schedule and mitigating the interest rate risk through various manners. And then, of course, annual index allocation. Another client I worked on, they had bought a policy 10 years ago, and they didn't even know that their entire cash value was sitting in the fixed account for 10 years. As you can imagine, that was a disaster for them. They were very upset at their original advisor. And these things happen. So it's important to have someone, and our team does this on an annual basis for all of our clients, to review these. Okay, I was going to pause for questions, but continue to write in questions in the chat as they come up, and we can jump right into case studies. So this case was a case that we closed last year. The client was it was a couple, but ultimately the main client was the wife. She was 50, the breadwinner. They had completely separate assets, and she sold her company for $175 million. There was no in-force life insurance coverage, significant estate planning done. So they had done a really good job at planning. She had pretty difficult health issues, not least of which was that she loved to go to the doctor. And I kid you not, she probably went to a different doctor every week. So she wasn't necessarily unhealthy, but they found just about everything you can imagine that could be a problem. And that can be difficult when you're getting close on a case, constant new records, right? We do have a solution we're prototyping right now, but we can get all medical records sometimes in 5 minutes, but at most in 24 hours, which, as you know, going from potentially 3 months of gathering APSs to 24 hours, that could be the difference on getting the case or not alone, right? So we're excited to roll that out, and we've been working on it in all our cases so far. But the client loved the doctor, and this was very difficult for all of us. So this was the paying cash solution that we showed her. $45 million of death benefit was her need, and they wanted to be done paying in 15 years. So $677,000, not a bad solution. Obviously, the key for this client was, how can I increase the IRR and allocate the least amount of capital possible to keep the rest invested? And we showed her, if she lives to age 90, that's a 7% return, tax equivalent, which is not bad, not terrible, right? But if we show financing, we were able to show her these options. And I'll skip through this, but this is just how financing works. But for the interest of time, I'll skip to this. So we showed her these three options. Option one was what you just saw, paying cash, $10 million over the next 15 years for $45 million death benefit. We assumed, maybe a little generous, her life expectancy was age 90. That would give her the 7.23% IRR. With financing, we could potentially almost cut her out of pocket in half. And we would increase her IRR to either 9.6% or 15%, because in option three, we are even hyper overfunding the policy and letting this death benefit continue to grow. So you can see by the time she's 90, it's grown from 44 million to 127 million of death benefit, which can be a very useful thing for a client who plans to continue growing their estate. Ultimately, she felt most comfortable with option two, and that's what we went with. And she was very happy. And, first year, we're getting to the end here. But this is just a very simple example of an estate tax planning case that we did last year, and how showing these options got the client across the finish line. So some key takeaways on this one. Presenting a few great options increases the closing ratio. Once a client says no, it's hard to change their mind. Why do we say that? Because we have so many advisors that come to us saying, I presented the paying cash option, right? I presented that. They said no. Now we should go show them financing. That is not the time to show them financing. Once they say no, it's hard to get over that hump. We want to go in with our best options on the first meeting. Let the client decide what level of risk they're willing to take. I can't tell you how many advisors come to me and say, I don't like financing. I was like, okay, that's fine. You don't have to like it, but your client is aggressive, or your client understands leverage. Let them choose. Like, we're here to give maximum transparency, and then we'll work to mitigate risk, right? Don't choose for them, okay? And then lastly, start with the problem. That's the takeaways on this one. Okay, the second case, this is a really interesting one for you, all of you who have been in the business a long time, or you run into clients that have in-force policies. Like, in-force policies are one of the greatest assets possible for leverage, and I'll explain why in a minute. So this client, they were 41 and 40 years old, both preferred, net worth of 40 million, but it was growing rapidly through private equity. And an advisor sold them whole life policies in the past as a bond alternative. So it was owned in their estate. But they were clearly underinsured, at least for what they anticipated their estate tax liability to be. So this is what we looked at. First was just their in-force coverage. They were planning to pay $500,000 towards their whole life premiums over the next 3 years. They had close to 11 million of death benefit, and this is what we walked them through. We said, look, you have $1 million of cash value. In the next 20 years, that is going to grow 800%. But your death benefit isn't growing at all, 10.9 to 11, right? Nothing. And we explained that's just an inherent inefficiency. It's not a problem. That's how they're built. This is a good policy, a good whole life contract. It was with MassMutual. But what if we could leverage that cash value that you no longer need in terms of accessing it as a bond portfolio to get you a lot more death benefit? And so we showed them these three options. So actually, first, let me walk you through how this works. So the lender would loan the premiums to the trust to pay for the new and the existing. So the $500,000 of premiums, they would loan those premiums. Then the trustee uses the in-force policy as collateral for the new insurance. they take 100% loan to value. The loan was fully collateralized. If they moved that policy into the trust, we could do no personal guarantee. So the only assets would be at risk, if you want to call it that, would be the 2 life insurance policies inside the trust. And the grantor, so them, would gift the interest, so the $500,000 for the next 3 years, into the trust to pay the interest. And then at rollout or death, the irrevocable trust pays back the lender, and the letter of credit, which is the line of credit would be paid back from the cash value or the death benefit. And then the total death benefit net of loan on the new policy and the in-force would go to the beneficiaries. So this is what that looked like. Column 1 was what they were currently planning to do. They had paid part of that $500,000 of premium already, so they had a little bit left on that 1 year. But they went from 10.9 million of death benefit that did grow by year 40 to 31 million to these options. And these are all the same options here. We essentially did a match cash flow design where their cash flow was exactly the same as they were already planning to pay, but we were adding on a $20 million survivorship IUL. And we showed if interest rates long-term are at 4%, this is what it looks like. If interest rate long-term at 5%, this is what it looks like. Even with interest rates long-term at 6%, they were better off doing this. And that assumes the caps don't go up and the whole life dividends don't go up. They were better off doing this until they were age 91 and 90, which is incredible, right? So if you look at all these years of death benefit, they're better off in column 2C than they would have been just keeping with what they had. But they have the opportunity to more than, essentially double their death benefit. And what I like to explain to clients on this is really it doesn't matter what the interest rates are long term. What really matters is the difference in a case like this between the interest rates and the crediting the policy receives. And so for the whole life policies, as you probably understand, when interest rates go up, dividends go up. That's a fact. And similarly for IULs, their caps go up as interest rates go up. So just looking at, for this particular carrier, we showed them since this carrier introduced Index Universal Life, the average spread between the performance and the all-in interest rate on these loans, which is here in this column, has been 3.4%. So we were illustrating, I believe, a 6% return on the IUL, the SIUL, and the dividend was 6%. So essentially there was almost zero difference in the column 2C between the interest rate and the crediting the policies were receiving. And they were still better off doing this for 40 years. So this is the kind of things we walk through with the clients and stress the importance of understanding what's going on behind the scenes here. So some of the key takeaways here on this one is oftentimes replacing isn't the best solution. So we almost never replace. We're looking to use that in-force cash value that you may or may not have sold. Someone else could have sold it. If it's a good policy, we can still leverage that cash value to get them a better outcome. And if you're not mining your book, someone else will. I actually was on a call with an advisor who's a Mass Mutual agent recently, and he showed me 10 cases with 500,000 of cash value and more. I ran numbers and we found a need for these clients, and he was skeptical of going to the clients and talking to them. 2 of those clients reached out to him in the 4 months since we did that and sent him replacement notices because someone else started speaking to the client first about a better opportunity. One was a SVUL, and the other was just a 1035 directly into a policy where they never had to pay any more premiums. Someone else will find those opportunities if you're not mining your own book of business. So I'd say key takeaway on this is go look at all the policies you've sold, or the clients that maybe you looked at their in-force and you thought, they're good. There's nothing I can do here. Maybe there is an opportunity that we can work on together. Just in the interest of time, this will probably be the last case study we do, but this one I call it the resurrection, the pivot. This one's a little bit complex, and this is a case where we would get our estate planning attorney that we have on staff involved in these cases. But ultimately, this was a husband and wife family office referral, net worth of $70 million, growing rapidly, and they'd used up all their exemption. $8 million of in-force death benefit and $2 million in cash value. So we thought initially what we were showing you prior. And the attorney initially told us they needed $20 million of additional death benefit. So in underwriting, they were both declined. So, as you can imagine, this advisor came to us very excited about this opportunity, and we went through the same thing. This is your in-force, this is what you're planning to pay, etc. And then we showed them this, exactly what we showed on the last one. Pay the same out of pocket, and we can get you $20 million of additional death benefit for life, right? They were extremely excited. They wanted to move forward. They were both declined. So we had to pivot. The advisor actually thought this case is gone. There's nothing we can do here. We have a plan that we call our GAT, Generational Asset Transfer, which some of you, it's a form of split dollar. Some of you might be aware, where basically, I won't spend too much time on this, but we can loan assets from Generation 1 into a dynasty trust for the benefit of Generation 2 to freeze the value of those assets. It falls under split dollar because we tie the repayment of that note to the purchase of life insurance on Generation 2. So mom and dad were uninsurable, but their 2 kids were not. So we were able to buy the 2 kids $40 million of death benefit, which meant at the time of mom and dad's death, they would come in and look at the value of the right to be repaid $40 million in 30, 40 years, whatever that time frame would be, the life expectancy of Generation 2. And the value of that is significantly less than 40 million. So this is ultimately what the results will be for these clients. Before planning, they were looking at a $22 million estate tax as of today. After planning, we cut down that estate tax by roughly $8 million. So the total inheritance went up to 55.6 from 47.6. And can't forget, we also got 40 million of death benefit on Generation 2 and the appreciation of assets outside of their estate. And that plans for the next generation of transfer taxes as well. Because that 40 million is estate tax-free to Generation 3 as well. So we're solving multiple problems here. And these transactions, as you can see, are extremely complex. I'm happy to go into the details on a future call if you have any clients that meet this. These are typically for clients 50 million net worth and above that usually cannot be insured. So mom and dad could be in their 80s or they're just uninsurable. So key takeaways on this: decline doesn't mean dead. And think of your older clients that might not be insurable but have greater than a 50 million net worth. I'm going to skip this case study in the interest of time and just jump to the key action items. Review your in-force policies you've sold. Think of your top 3 largest clients with a net worth greater than 20 million. These are the clients that really financing is good for. And then for those of you who maybe are looking at this and saying, I don't have these clients, like this is a different level. We can help in a lot of ways with that too. We identify 3 to 5 COIs that you think do have those clients, estate planning attorneys, wealth managers, whoever they might be, CPAs. And if you can get a meeting with them, we're happy to present with you. Anything that comes from that goes to you. We don't take any of those cases. If they happen to have a financing option, we'll help on those. But we can also bring our estate planning attorney into those meetings, who is a much better person to speak to other attorneys, quite frankly, than you or I, most likely. And you can schedule a call with us today and we can help you get these. Last thing on this is, I mentioned we've earned the respect of the industry. We have these co-branded carrier brochures that are great for clients as well. They're produced by Pacific Life, Penn Mutual, Nationwide, John Hancock, with our logo next to theirs. And they're great things to pass along to clients. We have them in digital form and print. I look forward to working with all of you guys, and especially just with Levinson & Associates in general. Really excited about the opportunity to partner. I hope we can have a big 2026 together. I'll pass it back off to you, Bill.
That was fantastic. I just got a couple questions for you real fast. I know we're going to get everyone out here before 3, and then we'll do our webinar giveaway, so make sure you're on until the end. But Mike, let's just pretend you're in a agent's chair right now, right? They're in Cedar Rapids, Iowa, right? They're on this training. And the first step is obviously you laid out some bullets, go through your book, and generally speaking, you're looking for a combined net worth of a minimum of about 20 million, is what you mentioned. Is
That's
that
right.
right?
Yep.
Okay. Okay. And
Um,
and then
the
let's
one
say,
caveat to
yep.
that, Bill. Oh, sorry.
Hmm.
One caveat to that. If they're like 38 years old and they just started making $3 million a year because they're doctors, like we have a lot of clients like that. That's a totally different story. Like they don't need to have the 20 million net worth.
Right.
Based
Right.
off income alone, they could qualify.
Because they're going to be there shortly, regardless. So, yep,
Yep.
that makes
Yep.
sense. And now you have a guy or girl, right? You're that agent in Iowa. You have a guy or girl that fits the criteria. We have a form we'll show you in a minute for all the agents, where you can get started, and then we will pass along the info to Michael and his team, and then they'll take it from there. But just real fast. So now you're that agent. You have a guy or girl, and now the next step is how so I would imagine you guys will be involved with the agent, and then they will turn over the client, and then you work on this together as a team. Is that right?
100%. Yeah. So first we'll want to have a quick meeting just to walk through everything you know about the client. And then we also come up with a list of things we need to know. If we don't know enough, you got to go back. And then once we feel like we have enough, we'll put together a design, review it with the agent, and only then we might make adjustments too if the agent wants to see changes. And only then will we set up a call with the client. And we would usually 100% of the time we'll do that call or that meeting with the agent involved as well. So we're all three on the call together, presenting the solution together.
Yeah, no, that's fantastic. So you're still in full control. You're still considered agent of record. You still keep the majority of the commission, depending on the plan. I know there's a few different arrangements, that Michael will also discuss with you when you have a case and the time is right. But this was awesome, and now you see too. It's not just fluff and words and a gray area. This is a carrier compliant platform. Okay, they've been doing this for, I think you said, almost 30 years now, Michael.
That's right.
Is one
Yep.
SCA? Yeah, yeah. So this is very different. I know we had some premium finance podcasts and webinars, presentations in the past. This is a very different concept and strategy, and now it's available to you because of our partnership with AmeriLife, which by the way, AmeriLife is the umbrella over Levinson and SCA, and that's why we're able to do this, and you can leverage this platform. So it's a win-win all the way around. So once again, Michael, you did a great job. What I'd like to do too is we'll have you on a podcast episode. Me and you will dive in the
Oh,
trenches
that'd be
together
great.
because I think
That'll
agents
be
will love it.
fun.
Yeah. Yep. Yep. Yeah. That'll be awesome. Okay. Good deal. All
All
right.
right.
Thank you again, Mike. I got a few slides left for the agents, and then we'll put a bow on this. Okay.
Thank you.
So let's jump. Yep, we appreciate it. Let's jump into my first slide. Like I said, we'll get everyone out in 5 minutes here. But that was amazing. I learned a lot. And by the way, I heard this presentation before, but it doesn't matter. I still walked away with nuggets. I hope you did too, because I'll tell you what, it's very eye opening, and it's a whole different part of our industry that most of you are not aware of, quite frankly. So it's great. Just opens so many doors, and you can imagine the commissions from this. I mean, it's like I said, coming for full circle, life changing. I mean, this is retirement stuff we're talking about here. Anyway, how to get started. Once you're an active Levinson agent with at least one company, you do get full access to the platform. We'll have everything here. In fact, there's our premium finance section, top right corner, and then you'll see an SCA section. Okay, and that's what Michael just touched on. Let's keep moving forward. So I want to talk about, speaking of the podcast, episode number 63. And this is another AmeriLife owned company, by the way. This is LeadStar. AmeriLife founded this company, created the company, and they are making ongoing changes to the company to make it bigger and better every year. In fact, every week for that matter. So The reasoning behind this is this gives you a full A to Z CRM sales system platform, call it what you want, built in dialer, recorder, and all of the various leads are built in, even seminar leads and mailers. So you could use this platform for the larger net worth clients, business owners, right? That Michael was talking about too. So it's not just for, over age 65 or final expense. So we have all bases covered. Check out that number 63 episode when you get a chance. Let's keep moving forward. Carrie's Corner, speaking of the partnership and what it means to the agents, right, that have been with us for 32 and a half years, right? And what does this mean to you? How's this going to help you in today's new world, right? In this fast paced world that you have to use technology like you never used before and use our back office, right? 100% of the time. So Carrie dove into a great article, Carrie's Corner, number 39. Check that out when you get a chance. I loved it. Let's keep moving forward. Another great benefit, okay? And this is above and beyond the new agent benefits platform, okay? So you now have access to group health insurance, to E&O that covers B-rated or better companies starting at $295. And I mean, the list goes on and on. Anyway, you now have access to Firelight, the annuity e-application platform with over 27 carriers. We launched it last night. I'm super excited about this. 100% complimentary to our agents. Let's keep moving forward. These are two great sample social media posts that we literally handpicked this morning. And here's what we love about these posts. So check this out on the left side, right? You always have to get scrappy and creative when you're marketing on social media, on your website, through e-blasts. By the way, you should be doing everything I just mentioned. On the left side, check this out. This was an agency, right, that basically built a receipt that it looks like an invoice from or a receipt from a dinner, and they spread it out and they put mortgage, child education, funeral expenses, credit card, car loan, and savings, right? They added everything together and said, this is what happens, right, when you pass, right, when there's a death, okay? And are you protected, right? It's an eye opener. It created over 30 likes, shares, and comments. That's 30 new free leads. Right hand side, top 5 reasons why life insurance is essential for young families. Okay. Just that alone created over 30, 40 comments, questions, and potential leads for free. Okay. So you got to do this stuff. You don't have to reinvent the wheel. I always say just change a few spokes. Let's keep moving forward. So the new AmeriLife, and this is important for you. So Scott Perry is the CEO, the one that really changed the direction of the company, right? They acquired Crump. Crump is huge, as we all know. About a year and a half ago, he has changed the game. I interviewed him for an hour. Okay, about a week and a half ago, 2 weeks ago, right before New Year's. You got to check this one out. It was one of my favorite interviews ever. And it just kind of gives you a good feel on the direction of the company and how they're looking at helping clients and agents and IMOs across the country. Let's keep moving forward. So, this is our training menu. Think of this as a dinner menu at a restaurant, right? Appetizers, entrees, desserts, everything is here when it comes to our live trainings, okay? And we have you covered for the next 3 months on the life, annuity, health, and supplemental product side. Everything's in front of you. We'll include this in the thank you email, and it's 3 o'clock p.m. Eastern Time, and we are on time, which is great. It's the second time in 26. This is my Positive Tuesday quote, and then we'll do our question of the day right now. So hopefully you walk away with an Apple iWatch. So, my quote: staying consistent and persistent, even when it's not immediately rewarding, is when the magic happens. Okay, sometimes you don't see the light, but your foot is still on the gas, and eventually you make that turn, and boom, the point is never let off the gas. Okay, keep marketing, keep staying scrappy in your efforts every single day. Come up with another idea, write it down, because if you don't, it means nothing, and then work towards those goals. Okay, personal and business. Question of the day. I spoke about, get your little fingers on the keyboard, by the way. You got to be quick and you got to be accurate. Question of the day. I spoke about our podcast, right, a few times. What was the episode number I did with LeadStar? Okay, I just spoke about it. Little hint. What was the episode number that I did with LeadStar? Okay, LeadStar is the leads platform, the CRM system with the dialer and the recording system. Everything's built in. Tell me the episode number and you win Apple iWatch and IUL prospecting book. By the way, speaking of IUL, there's a lot of chatter in the industry. We have an Allianz webinar coming up where we're going to compare whole life against IUL and show you all the pluses and minuses and performance. We're going to do a 5 to 10 year look back and show you the real facts and numbers, okay, and the comparison. And by the way, we have both, so as you know. Anyway, Andrew's going to tell us who is first and who's correct.
Yep, we have a winner. It is Roxanne B. Roxanne B.
Roxanne B. The episode number was 63. Congrats, Roxanne. Congrats to all of you because you hung in an hour with us, and I know you walked away with an idea or two. Any questions, reach out anytime. And then once you're set up or you have a guy or girl, fill out that form. We'll make the introduction, and then Michael and his team will take it from there. Great selling, and happy 2026, everyone.